Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to briefly talk about Silicon Valley Bank Fiasco, show you the new stocks that I bought this week during the banking system chaos, update you on a new brokerage account that I opened with National Bank, and finally briefly talk about the fact that this channel crossed 1000 subscriber mark yesterday. We have a lot to cover in this video, so let's jump right into this. We witnessed significant volatility and complete panic in the stock market on Monday and again on Wednesday. On Monday, 3 regional banks, particularly Silicon Valley Bank, went under and their depositors, which were mostly tech startups and small cap tech companies, basically bailed out by US government and Federal Reserve. And yesterday, on Wednesday, the banking system chaos continued by rumors about liquidity issues with Credit Suisse, which later on we realized it is also going to be backed by Bank of Switzerland, pretty much like US. The collapse of these banks caused a systematic fear and a lot of investors started to panic selling their stocks, particularly bank stocks. So the first thing that we want to see is why this happened. This is a recent publication by JP Morgan in which they basically analyzed the reasons for collapse of Silicon Valley Bank. And the most interesting piece of data here is this plot, in which they compared the Tier 1 capital ratio of various US banks versus the real adjusted Tier 1 capital ratio. And we can see huge difference between the reported CET1 ratio and adjusted CET1 ratio for Silicon Valley Bank, which is the real reason why this bank collapsed. CET1 ratio basically compares a bank's capital against its risk-weighted assets to determine its ability to withstand financial distress. It is basically a risk parameter, a measure for risk for the bank stocks, but smaller banks do not usually need to follow all the banking system regulations, and sometimes actually they include some shady accounting practices which masks the reality and the real numbers in this CET1 ratio. The difference between these two values in JP Morgan report, I mean CET1 ratio and adjusted CET1 ratio, are only two things. First, held to maturity securities like long-term bonds on the bank balance sheet, and second, available for sale securities on the balance sheet, which are usually debt or equities that the bank buys with the intent of selling before they reach their maturity. While the big banks, which usually considered to be important banks for the financial systems, have to follow certain criteria to report this CET1 ratio, and they are usually adjust their capitals for inclusion of available for sale securities, unfortunately smaller banks in US do not need to follow these guidelines, and JP Morgan's include this portion of information here regarding this difference. The goal of the chart is to illustrate the theoretical capital impact of an immediate liquidation of bank's entire investment securities portfolio, both HTM, which is held to maturity, and AFS, which is available for sale securities. For systematically important banks, no adjustment for AFS is needed because all AFS unrealized gains and losses are already reflected in the reported capital ratios. Unfortunately, this part is about regional banks. The regional banks shown have elected to add back certain capital losses to the regulatory capital, an option which is not available to larger banks. For the purpose of this analysis, to make regional bank capital ratios comparable to the 4 larger banks, we have reversed add-backs associated with unrealized losses in the AFS portfolio, since the 4 banks already basically reflected them. And that was the source of the problem with Silicon Valley Bank. They invested most of their depositors' money into long-term bonds and did not adjust their capital ratio for the losses on these investments. So when depositors wanted their money back, Silicon Valley Bank did not have enough liquidity to cover those deposits. And the market value of their long-term bonds were down significantly after recent interest rate hikes, and therefore the Federal Reserve and US government needed to intervene and bail out depositors, which were mostly US small cap tech companies. While this is a concerning matter for smaller US bank investors, I honestly don't really see any reason to be worried about large US banks, as demonstrated in JP Morgan report, and particularly Canadian banks. In sharp contrast to small US counterparts, Canadian banks are highly regulated entities with much different capital structure and capital ratios. For example, Canadian regulators recently increased their minimum acceptable Tier 1 capital ratio for Canadian banks to 11%. As an example, TD Tier 1 capital ratio is currently over 15.5%, which is even higher than JP Morgan, which had the highest capital ratio in US banks. If history and capital ratios can be trusted, I would say we don't have anything to be worried about in regards to Canadian banks. In my opinion, the day in which a Canadian large cap bank goes under, we probably should be worried about our lives as something catastrophic happened to the world or to our country, and the stock market would be the least of our worries. Anyway, yesterday I went shopping when everybody was panicking, and I increased my stake in TD Bank and EQ Bank as two Canadian banks in my portfolio. I bought 20 extra shares of TD Bank and 40 extra shares of EQ Bank. So now I own 120 shares of TD and 200 shares of EQ Bank in my tax-free saving account. It looks painful for now, but I'm sure that I will be a happy man in the next couple of years by buying Canadian banks during this chaos. I also bought 100 shares of Aritzia and doubled down on my position in this company. So now I have 200 shares of Aritzia in my TFSA. And in our combined portfolio of me and my wife, we have over 330 shares of Aritzia. Finally, I added 50 shares of Brookfield Corporation to bring my share count to a whopping 250 shares in Brookfield. Overall, I have 8 positions in my TFSA right now. I am happy with my weighting in Aritzia, Brookfield, EQ Bank, Granite, and TD. But I want to increase my stake in Couche-Tard, Canadian Tire, and Killamrit in the next couple of months. The dollar figure of my own portfolio at the moment is close to $70,000, and our combined grand portfolio of me and my wife worth around $88,000 today. To make these moves, I had to sell my Google shares inside my TFSA. My original plan was to eventually move my Google shares from my TFSA to my RRSP, and this was a great opportunity to do so, as Google was up on Wednesday and Canadian stocks were down huge. I still have 51 shares of Google in my RRSP, and I will try to rebuy the rest of my Google shares in my RRSP over the next couple of months. Inside the RRSP account, I still have my 51 shares of Google, 30 shares of Meta, 10 shares of Amazon, and 3 shares of MasterCard. I didn't have any transaction in my RRSP in the last 2 weeks, but I really like to increase my number of shares in Google, Amazon, and MasterCard at the moment. Okay, after reviewing the portfolio, another important update is that I decided to open a new brokerage account with National Bank for my international RRSP investments. There are 2 main reasons why I decided to do this. First, WealthSimple 1.5% conversion fees for converting Canadian dollar to US dollar, which can be annoying for larger deposits. But this was not really the most important reason for me. The most important reason was number 2. I cannot buy over-the-counter OTC stocks via WealthSimple. I'm interested to start a position in one OTC stock, and I couldn't buy that stock via WealthSimple. So overall, I decided to open a brokerage account with National Bank and try it out for a couple of weeks, buy stocks, sell stocks, convert Canadian dollar to US dollar, do Northbert Gambit to avoid conversion fees, journal shares over basically between the accounts, and use their research tools and try out the brokerage account. National Bank does not charge any trading fees on US and Canadian stocks. They will waive their annual fee if you have over $20,000 invested with them. You can do Northbert Gambit to avoid conversion fees from Canadian dollar to US dollar, and you will have access to OTC stocks, which is the biggest selling point for me. After I try all the features of this brokerage, then I will make a review video about National Bank brokerage account and let you know what I think about it, especially compared to WealthSimple. If I do like it, I will probably transfer my WealthSimple US account, US stocks, my RRSP account over there to National Bank. And if I don't like National Bank, I will transfer it out to another brokerage, potentially Interactive Brokers. So stay tuned for my review of National Bank brokerage account, which will come in, I would say, in 2-3 weeks. Finally, the last quick update. This channel now has more than 1,000 subscribers. Thank you everybody for subscribing to my channel and for following my videos. I really appreciate your likes, comments, and views. I honestly never predicted that so many of you may like my content. So thank you for motivating me to do research on stocks and continue to make these videos for you. I truly enjoy doing research and making these videos. And I cannot be thankful enough for this amazing investing community that we have here in this channel. There you are, guys. I hope you enjoyed the video and my transparency in showing you all the positions I have in my own portfolio and also my moves in the stock market. If you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.